The Australian economy expands at the fastest pace in 6 years, yet the Australian dollar slumps to the lowest level in more than 2 years. Global markets have been hit by waves of contagion in emerging markets these last few weeks. The Turkish lira has lost 30% of its value in the second half of 2018 so far, the Argentinian peso 23%, and the South African rand 10%. In recent days, the Russian ruble has slumped and it's down 10% so far this half. So going into Australia's second quarter GDP on Wednesday, traders could have been excused for being tilted towards the risks of a softer outcome. However, growth came in well above expectations. Real GDP expanded by a solid 0.9 in the June quarter, and annual growth printed 3.4% versus market expectations for annual growth of 2.8%. Indeed, the range of market forecasts was from 2 to 3.2%, meaning annual growth came in 0.2 percentage points above even the highest forecast among 25 economists. Now, to be fair, the 0.6 percentage point difference was due to a combination of an upward revision totaling 0.4% and stronger than expected growth for the June quarter of 0.2 percentage points. However, this was the strongest year-on-year growth since the third quarter of 2012 and significantly stronger than what we'd been led to believe and comfortably above generally accepted measures of potential growth for Australia of 2.75%. Now, there are plenty of qualms about the sustainability of growth, with the drought likely to become evident in the second half and slow wage growth squeezing the consumer. The tightening in domestic financial conditions plus increased global trade tensions may have an impact on the second half as well. However, commodity prices remain strong. The average price of thermal coal was $110 in August, up 42% versus a year ago. The average price of spot liquid natural gas in August was at $10.60, up 80% versus a year ago. And while the average iron ore price was down 12% on the year in August, export volumes have risen solidly, emphasising that the terms of trade is providing significant support for the Australian economy. Now, in stark contrast to all the above, the Australian dollar hit more than 2-year lows on Wednesday, the same day that the GDP report was released. The RBA noticed this weakness on Tuesday in its monetary policy decision, stating that the Australian dollar has depreciated against the US dollar along with most other currencies. So why was the Australian dollar the second weakest G10 currency over the week? The ongoing stress in emerging markets, including near neighbour Indonesia, and rising trade tensions between the US and China, and risks of more to come in coming days, have clearly been a factor. The out-of-cycle tightening in standard variable mortgage rates by banks in Australia has also weighed on sentiment too. The strength of the US economy, with the Fed set to hike rates later this month and in December as well, have helped strengthen the US dollar. So it looks like the Australian dollar should continue to hug 72 cents into next week. Now, next week we've some more up-to-date domestic data which may highlight the impact of domestic politics on confidence. The August NAB Business Confidence Report is out Tuesday, Westpac Melbourne Institute Consumer Sentiment on Wednesday, and the August Employment Report on Thursday too. Now, Thursday brings 2 important central bank meetings from around the world, with the European Central Bank and the Bank of England policy updates. US CPI for August is released the same day too. These are all factors we can talk about in next week's Markets Update.